Well, good morning. My name is John Thornhill. I'm the innovation editor at the Financial Times and also the founder of Sifted. I'm going to say a few words while our panel is getting mic'd up. And this panel is going to solve one of Saul's pet obsessions, how to generate enough growth capital in Europe. As Yoram was explaining this morning, it's not as though Europe is short of capital. It's not short of investment opportunities. It's not even short of VCs. In fact, I was reading that there are more VC firms in London than there are pret-a-manger sandwich shops, which makes you think about something. And what we are lacking, though, is at the later stages of growth capital. Up until the end of October of last year, early-stage European startups attracted 31% of total global investment, compared to 33% in the US. So there is, as we can see, and as we write about every day at Sifted, an incredibly healthy, vibrant startup scene, but it's at that later stage that we have a funding gap. So to address this, I'm going to ask my panel to come up on the stage, please. So. Great. So we have, from the file of Catherine Lewis-Latour, who is the Chief Executive of British Patient Capital, Avid Larizadeh Duggan, who is the Senior Managing Director of the Teachers Ventures Growth, which is, I think, part of the Ontario Teachers Pensions Fund, and Alex Seddon, who is the Head of Capitalist at M&G Investments, and Anne Glover, who is the Chief Executive and co-founder of Amadeus Capital. So I was looking at a report from New Financial Think Tank that over the past 25 years, the asset allocation of almost £3 trillion of UK pension funds, the allocation to equities in the public stock markets has dropped from 53 to 6% since 1997. And the proportion in going to VCs or direct private investments is also incredibly small. So, Alex, you are the perfect person to help us untangle this mystery. You work at M&G, a big city institution. How has that de-equitization, to use this horrible phrase, happened? Is it a result of regulation? Is it a change of investment philosophy? And why, in particular, is there not more focus on the early stage investment in particular?
Yeah, hopefully this is working. Anyway, I'll speak up. I mean, I think there's a number of different factors that have played into that de-equitization. Regulation is certainly one of them, and a sort of shift for pension funds to sort of match their assets and liabilities as they get later on in their sort of maturity. I mean, at M&G, I suppose we kind of were staring at this problem back in 2020, and that was the reason we launched M&G Catalyst. We were looking ahead and we were thinking about the climate emergency. We were thinking about healthcare innovation. We were thinking about increasing inequality. And I guess the realization we had was not only is there not enough capital being allocated to private asset funds, there really isn't the right kind of mandates for actually tackling some of these really big problems. And we've heard some of that in the panel earlier today. If you're trying to actually solve a problem like climate, you need to invest in technology companies, but they're asset heavy and the time horizons are really, really long. So it's not just there's a sort of multifaceted problems we're dealing with here. We're talking about pension fund allocation to private assets, but then our kind of next level realization was you then need the right kind of mandate for that capital. And our answer was it needs to be very flexible. It needs to be very long dated in its sort of investment horizon. And ultimately, we think it needs to be purpose driven. And we've heard a bit more about that this morning as well, because a lot of these businesses, entrepreneurs, management teams going after these really big problems, they're purpose-driven organizations. And we believe very strongly that mission alignment matters in terms of capital provision and matching with businesses. So, look, I mean, lots been written on the problems within the pension fund industry, the City of London. We just designed a mandate to address it, and we've got out there and we're investing, and we're kind of 2.5 years in, and we've committed over 2.5 billion of capital into this exact problem. And I think, there's lots of initiatives underway now to improve the problem further and to unlock more capital, but really you just need more capital. because the capital need here is absolutely vast.
And how do you think we could unlock that capital? What's the best way to do that?
I mean, look, I'm not an expert on that. I think people who read the newspapers can see that there's lots of initiatives being backed by the government and indeed the opposition. So I think people have identified the problem, and I think there's lots of very smart people focused on trying to unlock capital pools. And I think if you manage to do that, then you can then build out more investment capability, have more smart, well-informed investors, better able to meet the needs of these businesses. But you need the capital first, because these teams are expensive. You have to resource them. You can't just set up a team and hope for the best. So I do think measures by the government to try and encourage pension fund investment into, if you like, more productive parts of the economy is a key first step. And I think everyone in the room has been reading about all the various initiatives that are underway to do that.
Okay. Avid, this must seem like rather a strange debate to you, because the Ontario Teachers' Pension Plan has for many years been investing in exactly what we're talking about, in growth capital. Why is there a different investment philosophy?
So I think
Could
context.
you use the mic, please?
I'm mic'd up,
Oh,
so
you're
I should
mic'd,
be.
right.
Hopefully, people can hear me. Context is important on Ontario Teachers. We call it internally Teachers. Teachers has been around for 30 years, and it's been trailblazing even in the pension world for 30 years. And it's now a $250 billion asset manager that serves 330,000 teachers in Ontario. So if you can suspend disbelief on what the preconceptions that you have on pensions for just a couple of minutes, this is an organization that hires the best talent really to invest directly. So one of the innovation of teachers amongst pension plans is that 80% of what we do is direct investing, and only 20% goes through funds. In order to do that, as we're talking about, it requires talent, and it requires hiring the best talent. It requires compensating them properly. It requires creating the culture that helps them thrive. And so as part of this innovation in 2019, this is a learning organization that is constantly asking itself, are we doing the right thing? Are we generating the returns we need for our members? It decided to create this new asset class, which is TVG, which I lead in Europe, and that invests in Series B, really post-product market fit Series B and above, with check sizes of 25 million minimum to 250 million. We take minority stakes, we will lead rounds, we'll price them, we'll sit on boards, we'll create value, hopefully with entrepreneurs, and help them through cycles. And that last part is actually really important, because we have this long-term view. We invest through cycles. So what's happened in the last, call it 6 to 12 months, doesn't phase us. We're fully diversified. We believe in this asset class and its returns. And so we continue investing in it. And it's a global organization, and TVG is global. We have offices in London, obviously. And we have made about 20 investments so far since 2019, maybe a little north of 20. And 7 of those are in Europe, 5 are in New Palo Alto. And so we're quite bullish. So about a third of our portfolio today is in Europe, and we continue to be bullish in investing in this sector here.
You have this great kind of global perspective. So how much do you buy into this kind of sort of propaganda about the new Palo Alto? How high does it rank globally?
So I buy into it in the sense of the direction of travel is true. I came here from Silicon Valley in 2006. And I came from an ecosystem in Silicon Valley back then that was thriving, that was just, the VCs were together with the students, with the professors, with the entrepreneurs, with the corporates, all of which in this small environment. And I came to London, and I was surprised by the difference. We're talking about 2006. There was hardly an ecosystem. Now you fast forward to today, that has compounded on itself significantly. You have now angels that were former entrepreneurs that are investing in new entrepreneurs. Corporates are more involved. The American corporates have more presence here, are training, talent. You have VCs that are now much more ambitious than they were before, entrepreneurs that are much more ambitious, and capital that's coming in internationally and that's being formed here. All of that is true, and it continues to compound. And I think it'll compound at a higher rate because we are also where technology globally has taken over. Businesses now, what we're seeing with AI, for example, is going to go much faster simply because the infrastructure today exists. We already have the cloud, we already have compute, we already each speak the language of technology, and so do corporates. And so that speed is increased, and it'll be the same here. So I'm a buyer.
Good. Catherine, you run an organization called British Patient Capital, which suggests you are a patient investor, exactly the kind of growth capital that we need in Europe. What role do you think government-funded institutions play in supporting this ecosystem?
Yeah, maybe a couple of words on British Patient Capital. It does pretty much say on the tin what we do, but we were established 5 years ago. We're fully funded by the government to really attack this gap that we have in the UK for later stage funding, which we define as Series B+. And this came out of a piece of research that was conducted by Treasury, the Patient Capital Review, and I think the problem statement as identified there is fully recognized today. We had 2.5 billion as a funding envelope. The first part of the strategy was to invest in a portfolio of funds, VC funds, which we started doing in 2018. 2 years in, we started a co-investment strategy where we would be investing alongside our GPs. And then around 2 years ago, we set up our first direct investment fund for deep tech sectors. And again, that was on the basis that there was an insufficient amount of capital for hard companies in the UK. We have 375 million for that strategy, and we're about halfway through in terms of building our first portfolio, and I hope there will be, of course, subsequent funds that we'll be launching to continue the story. I think to answer your question more directly, the role of the government should be, you've got the best name, Alex, catalytic, to really be an early mover in these markets and to really show what can be done. But government is never going to be able to solve the entire problem. So I think it's really important that private sector organizations come forward to look at this part of the market and to start to really sign checks that will help the amazing talent and companies that we have in this country and across Europe really get their journey to the next stage. I think there are governments that have been very active in this area. I think the UK government has been very active. We've seen great initiatives in France as well over the last several years under Macron. And the Nordic countries have always been very forward-thinking in terms of what government funding can do in this area. So it can be catalytic. It's part of the story. We have 3 billion of assets under management, but we know that's a drop in the ocean in terms of what's really required to really exploit the potential that we have in the UK.
Mm-hmm. And to what extent are you investing directly yourselves, or how far are you investing via VC funds?
So about 2.5 billion is invested via funds, and also we have a co-investment strategy, so 250 million of that. And then we have a direct investing strategy, which is Future Fund Breakthrough, which invests in deep tech sectors. Specifically, we have the 3 Cs, 3 areas that we're passionate about. One is the future of computing, so quantum figures prominently in our portfolio, climate and climate tech. And again, on the hard side, and we've heard how capital intensive that is, but we think it's a really important area to double down on. And the third area is connectivity, and that's either machine to machine or human to machine connectivity, and our AI investments would come into that category. So those are the 3 areas where we're focusing. We'll build a portfolio of 30 companies. We operate very much like a VC fund would. All of my team have been recruited from the private sector, from VC houses where they've learned the business, and they're still learning, like you were, continuously learning, trying to work out what we need to do next, what we need to do better. But that's an important part of our strategy now. And I think over time, we'll be doing more direct investing than fund investing. We have, on the fund side, investments in around 40 managers. We've backed 70 VC funds. So we have become the largest domestic investor in domestic VC in the UK. That's not a mantle that we want to continue to hold. We'd love, a pension plan or insurance company to come in and hold that accolade. But for the time being, that's us.
Okay. And I mean, across Europe, there's also the European Investment Fund, which I think is about 10 billion euros of funds under management. And they want to be Europe's unicorn factory, I think, is their declared objective. But I meet quite a few VCs who actually think that this is not a particularly helpful role, that they're crowding out private investment or skewing the terms of deals. Is that a concern?
So I think our observation, again, because on the direct side, we're really focusing on deep tech, which is a severely underfunded part of the ecosystem, we don't feel that there's any danger of us crowding out capital. And actually, if we got to that wonderful stage where we were displacing private sector investors, we would withdraw. And in fact, success for us would be we don't have to be here at all. We can step away from this and we can solve some different market failures that need to be handled, can best be tackled by government. But we're a long, long way away from that with the strategies that we have. I can't speak for the EIF, but what I do know from my 30 years in the industry as well is that the EIF was incredibly important as a builder of the VC ecosystems across Europe. And I think, post the referendum, British patient capital came in to, if you like, replace the role that the EIF had played, specifically in the UK. I should also say that even though we focus on UK managers with a very strong footprint here, half of our portfolio companies are outside of the UK. So we have more than 1,000 companies in the underlying portfolio, about 500 in the UK. The other 500 are mainly in the rest of Europe, some in North America, some in Asia.
Okay. So Anne, Catherine's bank is an investor in you. Do you see her at all as a competitor?
No, not at all. We're completely colleagues and completely aligned. I mean, the fundamental difference, I think, is a sort of institutional attitude between BPC and the EIF. And the institutional attitude that Catherine just exemplified is we want to be there to catalyze and we'll be very happy to withdraw. And what what I have not seen any evidence of at all is them trying to crowd in private capital to their institution, whereas EIF wants to keep growing as an institution and crowd in private capital under its management. And that is a threat to the ecosystem because it's basically drawing talent away from the private sector. So it's the institutional leadership that's so fundamentally different between BPC and EIF. And, we chat all the time about how to make the UK a better place by attracting private capital to private managers.
Right. Now, the government has been talking a lot about trying to address this problem. The Labour Party has also come out with a big report on startup, scale-up capital and so on. Do you think they are addressing the core issues that you have identified? Alex, do you want to start with this?
Yeah, I think broadly the initiatives are all, pointing in the right direction. I mean, I think one of the things that I think a lot about, and I think is important to this whole debate, is if we are even broadly right about the new Palo Alto thesis, or if we really believe in what's going to happen in the next 10, 20 years, climate transition, accelerating healthcare innovation amongst two big themes, I think it would be an absolute tragedy if UK pensioners and long-term savers were not exposed to that value creation that we think is going to happen, right? So I think big picture, that's, I think, super important. And again, at M&G, the capital that we're investing within M&G Catalyst, that's coming from, Prudential branded long-term saving products. So people, normal retail investors buying long-term saving products and getting access to that, but it's not nearly enough. So you've got to think about if the value creation is going to come, then UK savers and pension fund, people who have pension funds should benefit from it. And then if you flip it around and think about the downside, think about the disruption of incumbent industries that's going to happen over the next 10, 20 years. If pension fund assets stay in existing incumbent industries, they're not exposed to private assets, the knowledge economy, technology, then they're going to be sitting on a whole bunch of stranded assets. There's going to be a lot of value destruction as well. So I think, fundamentally, this is the right direction of travel, right? It's not about risking up pension funds. It's about ensuring that they are exposed to the future, the value creation that's going to come.
This is not just an issue in the UK, is it? I mean, looking at some reports from the German Venture Capital Association the other day and Redstone VC, and they highlighted the fact that US pension funds own about 10% of Germany's tech unicorns, compared with just 0.2% held by the German pension funds. I mean, it's extraordinary that, as you're saying, North American investors in particular will own more of the upside of this new economy than existing domestic funds. Does that strike you as odd, Avid?
I mean, it's a missed opportunity for sure. I think part of it is potentially looking at it through a risk lens versus a reward lens. So that, there's a risk-reward equation, and if you focus too much on the risk, then you may not be optimizing or having a long-term view enough of things, which is what we do. And we have different, when we look at the pension overall, we have different asset classes with different risk-reward profiles, and there's a total fund management at the very top that decides where capital is being allocated and balances out over cycles so that we can do our jobs freely when we are investing directly in private assets. But that's done with very strong independent governance. It's done with investing in the right talent that can do this. It's done with a long-term view and also with truly innovation at the heart of the strategy. So I think all of these are important, but it takes time. So this machinery that I'm talking about has been built over 30 years. There's a real culture that's being nurtured to make sure that we're bold, that we take risks, we talk about it on a regular basis internally. And so it doesn't happen from one day to the next.
And Catherine, what do you think can be done to accelerate this process that we've all been talking about?
Yeah, I mean, it's a really good point, and the cultural piece about making sure that you have the right people with the right skills and aptitude, I suppose, for this part of the market to have those sorts of people present in our institutions is pretty fundamental, and to have them around the table when decisions are being taken as well. And that does take time to build. And I have to say, I've been following this debate for many years, and I'm somewhat optimistic as I sit here today, because I think there is a recognition that if you don't get a foothold today in the economy of tomorrow, you're out of business. And I think there's much more of an understanding from domestic institutional capital providers that something needs to happen. The question is, there's lots of different pieces of the puzzle to put in place. I think what's going to be the agent for change, the most effective agent for change that can galvanize and push all of that together in the same direction? I don't have an answer for that, I'm afraid, but I think that would be one of the fruitful things to think about in driving this more quickly towards something that I think is already on a pathway to a better place.
Mm-hmm. Do you think there's a possibility of trying to mobilize support from below, as it were? I mean, I was very struck by talking to one kind of fund manager the other day who recalled the time of the privatizations under Mrs. Thatcher and the whole Tell Sid campaign about privatizing British gas and the opportunities that there were to buy shares. If we're all agreed that pensioners in this country are going to miss out on the massive upside in this growth economy, is there a case for trying to make that case more directly to the investing public?
It's already made very successfully through the EIS scheme. Now, obviously, you have to have some reasonable income in order to want to be an EIS investor. But the UK has one of the best tax incentivized individual investment activities in the world in this sector. They're not pension funds, obviously.
Sure.
So the reason that I am much more skeptical about the groundswell at the sort of consumer level, I'm very supportive of the EIS activity, is that this is a skilled game of figuring figuring out who to invest in. And it's a skilled game of figuring out who to triage down to in order to build eventually the unicorns. So there are losses on the way. Being a passive, distant investor, you will experience more losses before you ever experience a winner. And I think that's very hard for an uninformed consumer to absorb. So the reason I think the pension funds are so important is that they sit on large pools and they can attract the talent who will understand how to analyze, allocate, and explain that appropriately. And it's a small proportion of the total pool. So you can take that risk with a small proportion of the total pool. If you asked a pensioner to put all their money into high tech, I would say don't do it, because there are more losses early. That's lemons ripen early. That's what they. So you really mustn't. I think we need the pensioners' support. I think the PR, but not the decision making.
Right. Okay. And Alex, I guess the other aspect of this as well is that a lot of pension funds you talk to will say, well, we're managing tens of billions of pounds of assets. We can only allocate a very small amount, which is not really going to make any difference in the grand scheme of things anyway. This is always going to be marginal for us because VC sector in particular is a small asset class. Is there just the tyranny of mathematics involved in this?
No, I don't think so. Look, I mean, scale is important. I'd agree with Anne. Because you need big pools of capital. You need very diversified pools of capital. And for a number of reasons, from a risk perspective, but also from a liquidity perspective, right? So some of these assets are very illiquid, and you don't ever want to have to sell anything when you don't want to, right? So I do think this is about aggregating large pools of capital. So yeah, one pension fund alone isn't going to change the world, but I think if the industry as a whole, the overall aggregate pools of capital, they do shift in even a small way, then it makes a huge difference. Then it will allow more investment teams, more capability to be built within the city or in New Palo Alto, wherever we want to put them. And then you start to get things moving in the right direction, because we speak a lot to founders as well as obviously to consulting with the government. But what founders all say is, look, the problem with building a business in the UK is just that lack of sufficient scale up capital, and it's not enough to just have M&G Catalyst there. You need to have a whole bunch of you need a number of equivalent funds or large pools of capital, maybe 4, maybe 5, even bigger pools than we have, in order to have to give confidence to founders that there's enough people to lead their rounds and to help them build their businesses in the UK or in Europe. And at the moment, that just doesn't exist, right? So it's that needs to be built. It's not going to happen overnight. It's going to take a decade. But in order for that to be built, there needs to be visibility of sufficient and significant pension fund capital into that ecosystem over the period, and then the rest will sort itself out over time.
A slightly different lens to just the returns, where there's a level of diversification of, it's not necessarily correlated to other asset classes in the same way. So that's a benefit of having that as a large asset manager. The other point is technology underpins everything we do today. And so the learnings that you get from being at the cutting edge, can be very useful for your other asset classes. And then if you are impact driven, technology drives so much impact in the world, whether it's climate, whether it's equalization from a socioeconomic standpoint. And so that's another reason to invest in that asset class. So I think it's not, even if there's a feeling that it might just be in the early days a very small part, ultimately that the benefits of doing that from an ecosystem standpoint are much bigger.
Mm-hmm. Okay, we're almost out of time, so I'm going to challenge you with one final question, which is, what is the one thing that you would do to try to change the situation for the better? How would we mobilize growth capital in the UK and Europe? Catherine, let's start with you.
Well, I mean, I'm just going to keep doing what we're doing. I mean, our own challenge is to scale up what we do, I suppose. So to try and work out how we make that happen.
Okay.
work towards creating better exit markets in Europe. I think that's a real impediment to there being more growth capital, because you just simply don't get the same types of returns the later you get.
And by that you mean the kind of public markets need to be.
Public markets, more, corporates here are not as acquisitive as the American ones are. Most, the large exits that you see are done either on markets in the US or by American acquirers. And so what can we do here that helps have better exit markets?
But I guess it's also an issue of some of those exit markets, or if you bought in 2021, then some of the IPOs that listed, you're not doing terribly well at the moment, are you?
That's true, but that's why you invest through cycles.
Okay. Alex?
Well, I think I've said it a few times, but we need large pools of capital to be more allocated into private markets and into the future economy. And I think one of the ways that you can do that is by, telling the story. And part of it is impact, right? I think everyone is waking up to the fact that the world is going to change in fairly dramatic ways over the next 10, 20 years. Part of that's driven by, emerging foundational technologies. We've talked about that already today. But part of it is the imperative of the climate emergency, right? Which means that all major industries need to be disrupted, or new industries created in order to deal with this collective challenge. So I do believe that imperative can be used as a motivator to drive allocators of the largest pools of capital to take more risk and to allocate into these future industries, because they'll start to see how the world is changing, right? So I do believe impact is a way in which this can be driven forward.
So I have to warn Catherine. So because when BPC was originally set up, one of the ideas was to prove the opportunity and then spin it out. And so I would spin out BBC into some kind of private ownership. She may not want to do this, and then attract more private capital and build a skill base that can invest in funds and can also do later stage direct investing. Because you need the capital, but you need the skills, and they're building the skills. And so I think I would love to see that happen.
Has this thought occurred to you at all?
Yes. Frequently, I think there needs to be the right time for that. I think it's a little bit early in our journey and where the ecosystem is. But it goes back to something I said earlier. There'll be a moment where we don't need to exist in the form that we exist today and we withdraw. Part of that could be because we're acquired by an institution that wants to have some kind of platform to enter into this market. So I wouldn't rule it out, for the future. I don't think it's imminent, and I don't think you'd find anyone against that proposition within BPC.
All right. Well, I think we're all agreed on what needs to happen. We just have to make it happen. So good luck with that. So thank you very much to all of our panel.